Thanks very much. My name is Morgan Housel. Thank you again for having me to do this today. It's really an honor to get to do this. What I want to talk to you about today is the psychology of money, which means I'm not going to tell you where the market's going next or where the economy might be going next. I just want to talk a little bit about what happens inside of our heads when we talk about greed and fear and risk and those kind of topics. I'm going to go ahead and share my screen here right now because I have some slides to share with you. So bear with me one moment while I get this going. There we are. And what I want to start today is a story of how I got started in this field. And I started as a full-time financial writer in 2008, which was a very interesting time to be starting as a financial writer because the world economy was falling to pieces. It was the global financial crisis in 2008. The stock markets, economies all around the world were falling apart. And I spent my early years as a financial writer trying to answer the question, what happened? Why did people behave the way that they did during the housing bubble of the 2000s, during the financial crash of 2008, all the behaviors that took place during and after those periods? Why did it happen? Just that simple question is what I wanted to answer. And I realized as the years went on, as I was looking into this topic, that you could not find the answer to that question in a finance textbook or in an economics textbook. You just could not explain why people did what they did during the financial crisis through the lens of finance or economics. But you could find subtle clues explaining why people did what they did through the lens of sociology and psychology and politics and history. Those fields had all kinds of insight explaining why people would go into a ton of debt to keep up with their peers or panic or be overcome with greed and fear. Psychology could explain that. Finance, by and large, could not. What that did for me as a writer is it just opened up this door into the idea that investing is not the study of finance. Investing is a study of how people behave with money. It's a study of how people think about greed and fear and risk. And that is a big, broad topic in which finance is only a tiny portion of it. And you can learn a lot about investing and investing behaviors through the lens of other fields. That investing was much more about behavior than it was finance. Now, what's hard about this is that behavior is very hard to teach, even to really smart people. You can't summarize behavior with charts and formulas and data. It's kind of a soft and mushy topic. And so it tends to get swept under the rug in investing, even if it's the most important topic in investing. So what do we do about that? As investors, as financial advisors, as people trying to make sense of the world, what do we do about this? To me, the only way to really wrap your head around the topic of behavioral finance is with stories. Stories of just real people dealing with risk and uncertainty that hopefully you can empathize with and wrap your head around to try to understand the softer side of behavioral investing. And so what I want to do with you for the next 40 minutes or so is share with you 4 stories, none of which have anything to do with investing at all. But all of them, hopefully you will see, have a pretty clear takeaway about how we as investors can think about risk and the behavioral side of investing and the psychology of money in a better and hopefully different way. And the first story I want to talk to you about today is what I call timing is meaningless, but time is everything. And again, this is a story that has nothing to do with investing. I want to tell you a story about this moment right here. Most of you will recognize this is the first second of the first flight in human history. December 17th, 1903, the Wright brothers in Kitty Hawk in the United States. And it's hard to overstate how important this moment was because the airplane went on to change literally everything in the world. If you had to make a list of the most important inventions of the 20th century, the airplane would be at least top 5, maybe even number 1. And it changed more than just transportation. It changed communication. It changed commerce. It changed geopolitics. It started world wars. It ended world wars. Like nothing was the same once the airplane came into use. And what's amazing about this moment is that you don't need any scientific background to really grasp how big a deal this is. This is not like mapping the genome or something where you need a scientific background to even understand what it means. This was a man flying through the sky like a bird for the first time ever. And so even if you were a child watching this moment, you could understand how amazing this moment was and how big a deal this was. So you can imagine how exciting this moment was for the world and how journalists, newspapermen started writing stories about how big a deal this was and how the world was changed forever now that we could fly. Except that's not at all what happened next. This I want to show you is the front page of the New York Times on December 17th, 1903, the day of the Wright brothers' first flight. And it's tiny print there, but you can take my word for it. There's no mention of the Wright brothers in there anywhere. This is the next day, December 18th. No mention anywhere. And the 19th, and the 20th, and the 21st, and the 22nd. There's no mention anywhere of what they were doing. And this actually went on for weeks. It went on for months. If you can believe it, it went on for years. 2 years after the Wright brothers first flew, the New York Times did an interview with a German hot air balloon tycoon. And they asked this hot air balloon tycoon, would humans ever fly in an airplane? They called them flying machines back then. And what this hot air balloon tycoon said was, quote, in the very, 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 very far future, there may be flying machines, but not now, not now. This was 2 years after the Wright brothers first flew. And the largest newspaper in the country didn't even know that they had done it yet. Now, there was one newspaper that covered the Wright brothers' first flight. It was the Dayton Herald. The Wright brothers were from Dayton, Ohio. And this is how they covered the first flight. And I love just how it's framed here. Dayton boys solve problem. Like it's a bunch of meaningless little kids who did a science experiment, really had no meaning in the world. The editor of this newspaper is a guy named Luther Beard. And years later, Luther Beard was asked why he was the only journalist to cover the Wright brothers' first flight. And what he said was, quote, I used to chat with them, the Wright brothers, in a friendly way, because I sort of felt sorry for them. They seemed like well-meaning, decent enough young men. Yet there they were, wasting their time day after day on that ridiculous flying machine. So the only journalists who covered this first flight didn't have sympathy for these poor kids. Now, after Kitty Hawk, the Wright brothers went back to Dayton, where they were from. And Dayton is really where they mastered flying. They were flying all over town. And Dayton was a really populated area during this time. So thousands of people were watching them do it. David McCullough wrote a great biography of the Wright brothers, and he talks about this period back in Dayton. And he writes, quote, not one reporter bothered to attend during this time, nor did public interest increase. With few exceptions, there seemed to be no public interest at all. No local excitement or curiosity or sense of wonder over the miraculous thing happening right in Dayton's own backyard. Now, of course, in due time, the Wright brothers got the credit and the recognition that they deserved, but it took years for it to happen. It took them 5 years to build the airplane, and then another 5 years before anyone was paying any attention to it. And this to me is interesting because if you think about the traits of successful entrepreneurs, people think about things like creativity, engineering ability, ingenuity, those kind of things. Rarely do we think of time horizon as a competitive advantage. But for Wright brothers, it absolutely was. Most of the other people trying to fly just gave up. They didn't have the patience to stick it out. Or to the extent that we do think about patience as an advantage, time horizon as an advantage, we often massively underestimate how much time is needed to put the odds of success or the odds of recognition in our favor. And that is also true in investing in a huge way. Let me show you what I mean. This is Warren Buffett's net worth over the course of his life, from age 14, when he had about $5,000 in the bank, to today, when he's worth about $120 billion. This is what he's been worth over the course of his life. And something that should stick out from this chart that I think is astounding, it's easy to tell from this chart, is that 99% of Warren Buffett's net worth was accumulated after his 50th birthday. 97% came after his 65th birthday. And this is so important because we as investors have spent so much time analyzing why Warren Buffett is successful. Why is he such a good investor? How is he so rich? How did he become so rich? And we go into grand detail about how he thinks about picking stocks and moats and business models and market cycles and valuations, those kind of topics, which are all really important and good topics. But we know, as a simple matter of math here, that literally 99% of Warren Buffett's net worth is tied to just the amount of time that he has been investing for. If Warren Buffett had retired at age 60 like a normal person, you would have never heard of him. He never would have become a household name. He would have retired with a couple $100 million, like a lot of people have in Florida. There's countless of them that you've never heard of. The only reason he's so successful is because of the amount of time he's been investing for. Is Warren Buffett a great investor? Yes, of course he is. He's one of the best. But his real secret is just the amount of time that he's been investing for. And that is so easy to overlook and to underestimate the amount of time that is needed to accumulate this kind of success. And this is true for us mere mortal investors as well. This is in the United States, going back to the 1870s, the maximum and the minimum annual returns you could have earned in the stock market based on holding period. So if you held stocks for 1 year or 2 years or 5 years, what's the most you could have earned and the least you could have earned on an annualized basis? That's what this shows. And something that should stick out from this chart that is so important is that it is not until between 10 and 20 years that every holding period finishes with a positive return. Not a good return, just a positive return, just not losing money after inflation. And this is important because if you ask most investors, are you a long-term investor? Most investors will tell you yes. Most investors think they are long-term investors. But then if you ask them, what does long-term mean? What's the definition of long-term? A lot of investors will tell you 1 year, that's the long term. Maybe 5 years, that's the long term. Even if we know a pretty good definition of long term, that definition of being not losing money after inflation is something between 10 and 20 years historically, just much longer than people assume. I think we have to remind ourselves that when progress is measured generationally, results should not be measured quarterly. It's such an important point in investing. And we need to recognize that the central problem that investors fall for in investing is underestimating the amount of time that is needed to put the odds of long-term success in their favor. And the single most important thing that you and anyone can do as an investor to become a better investor is to simply increase the amount of time you are investing for. It's boring advice, it's not exciting advice, but nothing makes even anywhere close to the difference in your lifetime investing success. That's the first story to talk to you about today. The second story is getting the goalpost to stop moving. And again, this is a story that has nothing to do with investing. I want to tell you a story about this guy right here, Stephen Hawking, one of the greatest scientists of our time, probably without exaggeration, one of the most brilliant men to walk this earth in modern times. Just an absolute genius who understood physics and how the universe works better than almost anyone. And of course, a quirk of Stephen Hawking's is that he had a motor neuron disease and he was left paralyzed virtually from head to toe. He had almost no control over his body. He spoke through a computer and he was paralyzed from head to toe. Now, he was not born like this. He grew up as an able-bodied child, and as a young adult, he was actually an athlete in college. He rode crew when he was in college. And he became afflicted by his illness when he was 21 years old, started becoming paralyzed when he was 21 years old. Now, a few years before his death, the New York Times did an interview with Mr. Hawking, and he talked about how excited he was about life and how happy he was with life, how much he loved his field and how exciting his research was and just how happy he was. And the New York Times asked him, they said, "Are you always this happy?" And Stephen Hawking said, quote, "My expectations were reduced to 0 when I was 21. Everything else since then has been a bonus." That's just such an astounding comment, just kind of a jaw-dropping comment. And it really highlights something that is important in a lot of areas in life, which is that your happiness, your satisfaction is not based off your circumstances. It's just so heavily tied to your expectations. And that is also true when we're dealing with money. You know, if you ask people in the United States, what was the best period economically in the United States? They overwhelmingly point to one period, one decade. That is the 1950s. The glorious 1950s that we remember as the golden era of middle-class prosperity, when anyone could have gotten a great middle-class job, raised a family with dignity on a good income, good benefits, good retirement. This is what we remember. Overwhelmingly, we have nostalgia for this period. And this is not just in hindsight. We knew it at the time in the 1950s that this was a glorious period to be in. Life magazine, where this cover comes from, wrote in 1953, they wrote, quote, The present and immediate future seem astonishingly good. The country has just lived through what was economically the greatest year in its history. So not only do we yearn for this era today, 70 years later, but we knew it at the time that this was amazing. And what have I thought is so interesting about this period, our yearning for the 1950s in America? And the idea that it was so much better back then, and we were better off back then, is how easy it is to disprove. I mean, the median income adjusted for inflation in 1955 was about $29,000 per year. The median income adjusted for inflation, $29,000 per year. By 1965, it was about $42,000 per year. And last year in 2020, it was about $64,000 per year. The average family, the median family, has double the inflation-adjusted income today that they did in the 1950s. And that's not just because more women are in the workforce now and there's more workers per household. Hourly wages have almost doubled during this period too, adjusted for inflation. We're almost twice as wealthy today than we were back then. And this is true for more things than just income. The average house in the 1950s was about 37% smaller than it is today. Food took up an average of 29% of a household's budget in 1950, compared with about 13% today. Workplace deaths were 3 times higher back then than they are today. The half of the age of men aged 65 and up were still working in the 1950s, compared with about a quarter today. Most people in the 1960s did not really have an expectation of retirement. The situation was you worked until you died. Very different from the expectations that we have today. And then so the question is, why do we yearn today for the 1950s? Why do we view it as this glorious middle-class prosperity era? I think the answer to that question is actually pretty easy, at least one of the answers, and it has to do with Stephen Hawking's wisdom about expectations. The 1950s were a very unique time in American history because there was not a lot of wealth inequality. The gap between the gap between the rich and the poor was much lower back then than it is today. We didn't have CEOs who were making 1,000 times as much as their workers. You didn't have athletes who were making $30 million per year. You didn't have hedge fund managers who were making billions of dollars. It was just a different era where that kind of thing did not occur. And because of that, because there was not a big gap between the rich and the poor, it was easy for most people to keep their expectations in check, to keep their expectations from growing faster than their incomes, because their expectations of what their lifestyle should be was not being inflated by a small group of very rich people who were living extravagant lives. It was just an era where it was easy to keep your expectations in check. And look, this is not a rant against income inequality. I'm a capitalist. I want everyone to be wealthy. But it was a really interesting period in that it showed what happens when your expectations are in check. It made people really satisfied with their lives relative to today. I think one of the biggest news stories in the last 40 years, most important stories, is the rise in wealth inequality, only because it made it so that it is easy for people's expectations to rise faster than their incomes. When they are watching a small group of very wealthy people live a very extravagant life, it's easy for ordinary, average people to say, that's the kind of life I should be living too. And when their expectations grow faster than their income, they're not very happy. The takeaway from that I think is so important, like I just said, is that if your expectations grow faster than your income, you will never be happy with your money. It's an inarguable equation, but it's so easy to overlook when we are thinking about money, when we're thinking about investing, when we're thinking about wealth. Wealth is a two-part equation. You need to earn money and you need to keep your expectations in check relative to that income. It is so easy to overlook the second part of that equation. Let me show you an extreme example of what happens when you don't. Most of you will know who this guy is. Bernie Madoff, the biggest fraudster in financial history. He stole literally tens of billions of dollars from people in his Ponzi scheme. But Bernie Madoff has a really interesting part of his life story that went overlooked during the fraud, which is that if you go back to the 1980s, before his fraud started, Bernie Madoff was making, by some estimates, up to $20 million per year from the legitimate side of his business, not the fraud side of his business. The real legitimate side of his business as a market maker in the stock market, he was making $20 million per year. What's astounding to me is that apparently inside of the mind of Bernie Madoff, he said that's not enough. And he wanted more so badly that he was willing to start a giant Ponzi scheme that ruined everything in his life. Now, that's an extreme example, but I think we all have some tiny, innocent, law-abiding version of this. That if we're lucky enough to do well in life and earn a good income and grow our net worth, oftentimes our expectations might grow faster than that, and it just leads us wanting more, no matter how much we have. And that's why, by and large, people don't tend to be as happy with their money as they thought they might be. Now, years ago, two authors, Joseph Heller and Kurt Vonnegut, were at a party at a hedge fund manager's house in the Hamptons. And Kurt Vonnegut turned to Joseph Heller and he said, "Did you know that the hedge fund manager who owns this house makes more money per year than you, Joseph Heller, have earned in your entire life?" And Joseph Heller said, "That might be true, but I have something the hedge fund manager does not have, which is enough." This, I think, is the most important word that exists in finance. Because no matter what we do with our money, no matter how we invest our money, if we don't have a sense of this word, it's never going to feel like it's enough. We're never going to be satisfied with what we might be lucky enough to accumulate. That's the second story. The third story is that risk is what you don't see. And this too is a story with nothing to do with investing. I want to tell you a story about this guy right here, Harry Houdini, one of the most famous magicians to ever live, who did most of his work in the United States about 100 years ago. And Houdini, of course, was known for his escapes. He would tie himself up in chains or in a straitjacket, and he'd throw himself in a river or bury himself in sand, whatever he would do, and he would escape. He'd find his way out. He was the best in the world at this. This is what he became famous for. But Houdini had another trick that he played during his shows. And audiences loved it. He wasn't famous for it, but they loved it. And what he would do is at the end of every show, he would invite the largest, strongest man onto stage from the audience, and he would tell that man to punch him in the stomach as hard as he could. So Houdini would stand there with his hands up, and the guy would punch on him as hard as he could, and Houdini wouldn't flinch. His claim to fame was that he could flex his stomach in a way that would absorb anyone's punches. So audiences loved it. They had a different sense of humor than maybe we do today, but this was a big hit at the time. And now one day after a show in 1922, Harry Houdini went back to his dressing room and he invited a group of college students back there to meet him. One of the college students was a guy named Robert Whitehead. And Robert Whitehead walked up to Harry Houdini and he started punching him in the stomach as hard as he could. He didn't mean any harm. He wasn't trying to pick a fight. He just thought he was doing the trick that he had just seen on stage. Now, Houdini was not prepared to be punched. He didn't see this coming. He fell to the ground in pain. He said, "What are you doing?" Robert Whitehead said, "I'm so sorry, Mr. Houdini. I thought I was just doing the trick." Houdini said, "I'm not prepared. I wasn't flexing my stomach, and now I'm in a lot of pain." Harry Houdini went to bed that night, doubled over in pain. He woke up the next morning. He couldn't even get out of bed. He was in so much pain. His appendix had ruptured the night before, almost certainly from Robert Whitehead's punches. And Harry Houdini died later that day. This is how the great Houdini died. And what I think is astounding about this is that Houdini was like the best in the world at surviving big risks. No one else was better at surviving big risks than Houdini. But those risks, like tying himself up in chains, he was prepared for. He knew it was coming. He had a plan for it. It was never a surprise. The one thing that killed him, that he could not survive, was just a skinny college student's punch that he didn't see coming. And what that shows, the takeaway from that that's so important for us, is that how risky something is depends on whether you're prepared for it. Not how big you think the risk is, not how much damage you think it can cause, just whether it's a surprise or not. And that's also true in the economy, as we've learned so starkly over the last year and a half with COVID. I mean, one of the things we've learned, I think the biggest lesson from COVID, is that the biggest economic risk is what no one's talking about. Because if no one's talking about it, no one is prepared for it. And if no one's prepared for it, its damage gets amplified when it arrives. I mean, we spent in this industry the better part of the last decade debating what is the biggest economic risk. That's the question that takes up all the oxygen in the industry. And we tend to personify these risks. So people asked in the industry, they said, was this guy the biggest risk to the economy? Was it Barack Obama and the tax hikes of 2013? Was that the biggest risk? Was it this guy here? Was it Ben Bernanke? All the money printing after the financial crisis, was he the biggest risk to our portfolios? Was it this guy? Was it Donald Trump? The trade war, the erratic policies of the last 4 years, was he the biggest risk? Again, this is what took up all the debate in the economics field for a decade. And what's astounding about this is that we know in hindsight, the answer to the question, what's the biggest risk to the economy, is none of these three guys. By far, the biggest risk was this guy here. It was a virus that no one was talking about. It was not in any analyst forecast, any economic outlook until the moment it arrived, and 30 million Americans lost their jobs in 2 months. The biggest risk is what no one was talking about until it happened. But I think if you look historically, that's always the case. I mean, the risks that we talk about that are in the news are things like trade wars and next quarter's profits, budget deficits, elections. And it's not that these things don't pose a risk. It's that they're not surprises. Maybe they're written about in the newspaper every day. Maybe you don't know who's going to win the election, but you know there's going to be an election. It's not a surprise to anyone. But if you look historically, what actually moves the needle, what actually makes a difference in the economy, in your portfolio, it's things like COVID-19. And Lehman Brothers couldn't find a buyer in 2008 that started the financial crisis. September the 11th, the terrorist attacks. Pearl Harbor, which dragged America into World War II. Those are the things that actually make a difference and are an order of magnitude more important than all the other little news stories that we read about every day. And the common denominator of these stories here is not that they were big, it's that they were surprises. It's that no one saw them coming until all their damage had occurred. And I think that can be kind of disheartening for people to hear as an investor, that the biggest risk is what you don't see. The biggest risk is what no one's talking about. But I think there's two ways to think about this, to think about risk in a better way as an investor. One is to think about risk as an investor the same way that California thinks about earthquakes, which is having expectations instead of forecasts. What I mean by that is this. If you live in California, you know that earthquakes are going to be a big part of your future. Guaranteed. But you can't predict when the next earthquake is going to happen. No one can forecast the next earthquake. There's no earthquake CNBC of 24/7 coverage of people analyzing when the next earthquake might occur, like happens in financial markets. It just doesn't work that way. So rather than forecasting the next earthquake, you just have an expectation that one might occur at any given moment. And they're always prepared for an earthquake to come. I think thinking about risk in financial markets in the same way is the best that we can do. Because look, if I were to say, hypothetically, the next recession will occur in the second half of 2022. Yeah, I'm just making that up. That's a forecast. But if I were to say, historically, there are about, on average, 2 recessions per decade. And I expect that to be the case going forward. I don't know when they're going to occur. I don't know what's going to cause them. But my baseline expectation as an investor, as an asset allocator, as a household, is 2 recessions per decade. It could start at any given moment. That's an expectation. It's very different than a forecast, which is assuming that you know when these things are going to occur and what's going to cause them. The other thing to keep in mind is understanding the difference between getting rich and staying rich. They're 2 completely different skills, and you need to learn how to get them to coexist to do well as an investor over time. Getting rich requires being an optimist, taking a risk, being a long-term investor, being an optimist about people's ability to solve problems and for the economy to grow. That's what you need to get rich. Staying rich requires almost the exact opposite. It requires a degree of pessimism and paranoia and an observation and acknowledgement that the short term of history is a constant chain of surprises and setbacks and disappointments and recessions and bear markets and pandemics that you need to be able to survive financially in order to stick around long enough for your long-term optimism to actually pay off. That's the third story for you. The last story I want to tell you today is that everyone has a different view of the world. And I want to start this by showing you the fatalities that took place during a bunch of well-known events in the United States and around the world. Hurricane Katrina in 2005 killed about 1,800 Americans. Pearl Harbor during World War II killed about 2,500 Americans. The September 11th terrorist attacks killed 3,000. Allied soldiers on D-Day, again during World War II, was about 4,400 fatalities. The next I want to show you is an estimate of the number of deaths that would take place during a rupture of the Cascadia subduction zone, which is a very specific kind of earthquake that would occur off the coast of Washington State near Seattle. Our best estimate, the baseline estimate, is that 16,000 Americans would die during this kind of earthquake. The best estimates for the odds that this will occur in the next 50 years are 1 in 10, which is a lot. Now, it turns out that when most people think about earthquake risk in the United States, they think of two cities, San Francisco and Los Angeles. But any way you look at the numbers, Seattle is at by far a bigger risk, the biggest risk of earthquake risk in the United States. The similar numbers for a major earthquake in San Francisco and Los Angeles are between 2,000 and 5,000 deaths. Seattle, it's 16,000, and it's a smaller city. And the reason that this number is so high, by and large, is not just because Seattle's geography predisposes it for a major earthquake. That's part of it. But most of the reason this number is so big is because any way you spin it, Seattle is not prepared for a major earthquake relative to San Francisco or Los Angeles. California has had a pretty good earthquake building code for skyscrapers since the 1930s. Washington State, by comparison, barely had any earthquake code that had teeth until the 1990s. California, decades ago, passed voter-approved bonds so that the owners of big skyscrapers could take out cheap loans to retrofit their buildings so that they can survive a big earthquake. Seattle and Washington State, by comparison, cannot even pass within its budget the ability to do a survey that maps out where all the high-risk buildings are even located. And you go on down the list, the preparedness among firefighters and emergency crews, much greater in California than it is in Washington. Mandates about signs and evacuation routes in hospitals and schools, much greater in California than it is in Seattle. And what's interesting about this is that the people of Seattle, where I happen to live, by the way, have the same data as anyone else in California. They love their families as much as anyone in California. But they've, by and large, done nothing to prepare for the next earthquake, while California has moved mountains to prepare for it. Why is that? I think the answer is this. California has lots of small and medium-sized earthquakes. So if you live in California, you are constantly being reminded, sometimes at 2 in the morning, being woken up shaking in your house, that earthquakes are a part of your life. You feel shaking on a maybe monthly basis if you live in some parts of California. It's just part of your life. Washington State, by comparison, does not have lots of small and medium-sized earthquakes. They have massive earthquakes that occur every few hundred years. And so if you live in Washington State, you don't have this part of your culture, this constant reminder, this constant being woken up shaking that earthquakes are part of your life, like you do in California. And what that shows is something that I think is really important, which is that when people think about risk, they don't do it in an analytical way. They don't just look at the data and then make their action based off the data. When people think about risk, they do it in a cultural way. And everything that you think is risky and your willingness to respond to risk and do something about potential risks is heavily tied to the culture of where you live and the generation you are from and the values that you were raised in, these kind of things that are not necessarily in our control. We want to think that risk is like a force of nature, that it applies to everyone indiscriminately, and it does. But that's not how people think about risk in the real world. Whenever people think about risk in the real world, they become heavily tied to the unique circumstances of their own lives, where they live, when they were born. And that is also true in investing. Let me show you what I mean. This shows the US stock market, what the US stock market did in your teens and 20s, your young and impressionable teens and 20s, when you're learning a baseline foundation of knowledge about how the world works, based on what year you were born. If you were born in 1970, the US stock market went up tenfold during your teens and 20s after inflation, that's an amazing return. If you were born in 1950, the market went nowhere during your teens and 20s. They earned a 0% return after inflation. I would just ask, do you think these two generations went through the rest of their life thinking the same thing about the stock market? That it was capable of delivering the same returns or had the same amount of risk involved in it? And the answer is no, of course not. It stuck with them for the rest of their lives. This is true for something like inflation as well. If you were born in the 1970s, inflation averaged about 8% per year. If you were born in the 2000s, it averaged about 2% per year. In the 1930s, during the Great Depression, it was negative 1% per year. And Venezuela, just in the last 2 years or so, was about 1,000,000% inflation. You can't even put a bar and go through the ceiling here. Again, do you think these generations think the same thing about inflation? They have the same data. They're just as smart as one another. But they think very differently about inflation just because of the dumb luck of their personal circumstances. Let me give you one other example, a very stark example. The unemployment rate in the United States in December of 2010 was 10%. That was the overall unemployment rate. But if you break that out by different economic groups, you see some enormous skews within there. During the same month, the unemployment rate for Caucasian females aged 45 and up with a college degree was 3.7%. At the same time, the unemployment rate for African American men aged 18 to 26 with no high school diploma was almost 50%. No one should think that these two groups should think about the economy in the same way, that they have the same economic outlook, that they think about risk and opportunity in the same way. They're seeing the world through a completely different lens because of this. Even if one group is just as smart as another, they have access to the same amount of data, they're seeing the world through a very different lens. Now, years ago, I interviewed Dr. Daniel Kahneman, and we talked about a study that a group of Stanford researchers did, where they looked at a bunch of brokerage account data, and they wanted to answer the question, how does this actually impact people's lives, how they invest? How does what we've experienced in life impact how we invest? And what this research showed was that if you grew up during the Great Depression, you were half as likely to invest in stocks compared to those who grew up in the 1960s. If you grew up in the 1970s when inflation was really high, you were 1/3 as likely to invest in bonds later in your life compared to those who grew up in the 1950s. If you grew up in the 1980s, you were twice as likely to buy stocks compared to those who grew up in the 1970s. And their big conclusion when they put all this together was, quote, our finding suggests that individual investors' willingness to bear risk depends on their personal history, not on their intelligence, not on their data, not on who their financial advisor was, just the dumb luck of where and when they were born. And now during this conversation with Daniel Kahneman, he mentioned at one point that he's the biggest pessimist he's ever met. He said, no one is more pessimistic on the outlook of humanity than he is. And I said, wow, that's astounding. Is that because you have all of this insight into our biases and how people think about risk all wrong? And he said, no. He said, I'm a pessimist because I grew up in Nazi-occupied France. And he said, I saw from an early age how evil people can be. And that, of course, is not an experience that I had. But that was his life. It was his experience. I can try to be open-minded and empathetic to something like that, but I don't have the emotional scar tissue of someone like himself or millions of other people who lived through that. And that's an extreme example, but I think we all have something like that. That whenever we're thinking about risk, we become prisoners to our past. And we think about risk in rational and unbiased ways, but no one does. We all just anchor to our personal histories. So we asked Kahneman, what can we do about this as investors? And true to his pessimistic self, he said, there's nothing you can do about it, just deal with it. But we pushed him a little bit further, and he said, okay, keep two things in mind. Number one, talk to as many people as you can as an investor, particularly investors from a different generation and different countries than your own. Because those are the people who've likely had different experiences than you as an investor. And therefore, they're likely to hopefully open your mind to the range of possibilities that you yourself might experience during your lifetime as an investor. The second thing that I think is so important here is realize that people who make different financial decisions than you are not always crazy. Investing is not like math where 2 plus 2 equals 4 for everyone. There's one right answer no matter who you are. Investing is a much more personal endeavor. And how I think about risk in my own household is different than how you think about it. Not because either one of us is smarter than one another, just because we're different people. I think a big realization in understanding behavioral finance and the psychology of money is realizing that personal finance is very personal. And you need to become introspective about who you are, what your risk tolerance is, what your goals are, what you really want out of life, and realize that those decisions might be different from other people around you, and that there's no one right answer that any of us can anchor on. And so if there's a common denominator of these stories today, it's that when people tend to think about risk in the economy and in their investments, they tend to think about what's going to happen to them. What's the stock market going to do to me? What's the economy going to do to me? That's how most people think about risk. I've always thought that a better way to think about risk is just not what's going to happen to you, but what you do to yourself. It's your own biases, your own misconceptions, your own impatience, anchoring to the unique parts of your own life. That's your biggest risk as an investor. And a lot of investors don't want to hear that you're your own worst enemy as an investor. But I've often thought it's actually a pretty optimistic realization. Because, of course, you have no control over what the market's going to do next or what the economy is going to do next. The only thing you have control over as an investor is your own behavior. And when you realize that behavior is actually also the most important part of investing success, that's actually pretty optimistic. So I want to close today with an investor named Bill Bonner, who has a quote that I love, who says, "People do not get what they want or what they expect from investing. They get what they deserve." Not about how smart you are, it's just about how you behave. Thank you very much.